So our next panel is talking about something that I know every startup is always interested to hear, and that is current investment trends and alternative funding opportunities for fintechs. On the panel, we have John Bailey from Invest Victoria, Matt Vital from Virtual, Kathy Lyle from Seed Space Venture Capital, and Matt Dowling from Lighter Capital. And moderating the panel, we have Jackie Bloom from Startup Bootcamp. Take it away.
Thank you. Are we on? Great. Good morning, everyone. I'm Jackie Bloom, Growth and Investment Director for Startup Bootcamp, and incredibly honoured to be moderating this panel this morning. As mentioned, the topic today is current investment trends, and I think that's certainly a topic at every startup founder's heart. And what I wanted to add to that is the theme being navigating change, and it's perfect. I think today around navigating change, we've just come off the back of a conversation in the women's breakfast this morning, which was all around navigating change within the startup industry, but also within fintech. And so this is perfect to continue the conversation, and particularly around investment as well. So really interesting. Just before I start asking questions, I would love to introduce our fabulous panel here. So to my left is John Bailey. In his current role at Invest Victoria, John leads the Special Financial Projects and Risk team responsible for developing and implementing important startup support initiatives. John has over 40 years' experience both in banking and credit analysis in Europe, Asia and Australia. Prior to joining the Victorian Government, John was Managing Director at Standard & Poor's, the world's leading credit rating agency, where he held a range of leadership roles in credit research, business development and project management. So welcome, John, and thank you. Matt Vitale. Matt is co-founder and CEO of Virtual, Australia's leading equity crowdfunding platform. Matt is an experienced financial services lawyer and entrepreneur, having worked in private practice at a top-tier law firm and founded several successful businesses. A recognised expert in the regulation of financial services and crowdfunding, Matt is a regular media commentator and contributes to scholarly journals and industry consultations. So welcome, Matt. Kathy Lyle. Catherine is an experienced senior executive, board member and strategic advisor with over 30 years of experience across capital markets, finance, banking, government and fintech in Australia and the UK. She is a vocal advocate for diversity at all levels of financial services and has been named in numerous publications, but most importantly in Financial News and Innovate Finance Top 100 Women, the Top 35 Women in Fintech Investment, and is a mentor for inspiring rare birds. She has twin 10-year-olds, I take my hat off to you, and is former slalom canoeist and juggles work-life from Kiama, New South Wales. I think that's enough to juggle work-life anywhere, really. And last but not least, Matt Dowling. Matt is an investment director at Lighter Capital Australia. Lighter Capital provides loans to companies with SaaS or transactional recurring revenue. Over the past 12 years, Lighter Capital has lent to over 500 companies with over 1,100 rounds of financing in Australia, USA and Canada. Matt speaks to founders daily, looking at raising non-dilutive capital to grow their business, and has worked in 3 startups over his career, with the most notable being the online gambling giant Betfair. So really, really interesting range of panel members here today, and certainly perfect for the conversation around navigating change. John, I'd love to start with you, being the government sector and the government voice today. So tell us a little bit more around how the Victorian Government is supporting startups, and if you can describe a little bit around different funding programs for startups as well.
Yeah, thanks, Jackie. I think to set the scene and looking at the theme of the panel discussion here, funding options have changed markedly over the years, and government is one of those changes as well. We've got Matt here as far as crowdfunding is concerned. We've got Matt again as far as venture debt is concerned, and VC is changing a lot as well. So part of those changes is also occurring with government. The Victorian Government really believes in startups. They understand that that's where research and development comes from, that's where the job multipliers come from, and so we've, as a consequence, set up a number of programs to support startups in the sector. So we've done a lot of mapping. We've done a number of things, and I won't go through in too much detail, and we could talk about it later on. But there's a number of things. We've set up 2 venture debt funds that are operating nationally, but particularly in Victoria. Lighter Capital is one of those. One Ventures is another, and we think that's been very important in this down round environment. So set up 2 venture debt funds. Importantly, with matched funding from private sector, so it's just not government out there picking the winners. We've also set up a $20 million equity investment attraction fund. We're trying to use this to attract the best-in-class tech startups and technology into Victoria. We've made a number of investments on that. And we also have the Breakthrough Victoria fund, which is a $2 billion fund, which is in the market, has been making a couple of big investments in quantum computing and so forth. And I think importantly to our discussions before is we have set up, and this has been one of our successes, is the Alice Anderson Fund, which is really investing into female entrepreneurs in the tech sector. And that's been particularly successful, and we've actually just topped up the money. So that's on the supply side. On the demand side, and I think that it's important that we focus on demand also, is we have LaunchVic, and LaunchVic is doing a lot around education, has been doing a lot around supporting angel investors and so forth. So we've tried to be as creative as possible and to talk to people about where the gaps are and where we can support them.
John, thank you for sharing some of that. Just for the entrepreneurs or startups in the room who are seeking further investment or are seeking investment, and particularly you mentioned the newer initiatives around the debt funding, what are the best ways that they can go about actually accessing that funding?
So a lot. Some of them have actually used the private sector to be the managers. So you put your application into the letterbox as far as the fund managers. So Matt is one of those at Lighter Capital, and as I said, One Ventures. Other than that, we have on our websites, we would have points where you could access to talk to us. If not, I'm here as well too, so to speak to myself. But there should be, and I will agree that government can be a labyrinth.
and that's why I thought if we can help some of them
that was a loaded question, wasn't it?
Yeah, navigate and help navigate, and perhaps use a fintech of some description or a tech capability, to go through that process. So following on from a debt conversation, I'd actually like to point the conversation to you, Matt, around debt. Matt Darling from Lighter Capital. So with the evolving landscape of fintech, how does debt or how has debt proven to be successful in supporting the growth of fintech startups? And I think elaborating further on that question, you and I had a conversation outside around, interestingly, the different types of startups who are actually approaching you and getting access to the funding and the success rate of that. So,
yeah, thanks, Jackie. I think debt's just one part of the pie. I mean, you've got the equity part. At the moment, valuations aren't great, probably back to normalised levels, but they're not great on a perceived level. Growth is hard for some companies. The fintech sector might be punching above its weight compared to other sectors, but growth's a big thing to fund. So companies come to us we look to fund execution and a bit of certainty. So companies know their marketing channel, know what it costs to acquire a customer. Instead of going and raising venture capital or crowdfunding, for example, on the equity side, they might come and get a small amount of debt and grow that way. They may be using us to bridge to a bigger equity round. They quite haven't got the metrics in place yet or got their growth in place yet to get what they perceive as a good value round, and they use that debt to grow their business. So there's different. We sort of tend to fund transactional recurring revenue or SaaS recurring revenue businesses on our side, usually up to sort of $4 million US. We can fund out of our Australian fund or our US fund. But the other debt pieces available. There's proper venture debt. So we sit in the more earlier stage businesses. We'll fund a multiple of 4 times your monthly recurring revenue on the higher gross margin businesses, but there's proper venture debt players who sit above us, like the One Ventures, like the Partners for Growth, for example, who will fund, looking for companies between $3 and $30 million businesses, and they'll fund a higher multiple, probably a slightly less interest rate, but they'll take a small equity piece in that play. So the big thing for us, what we see companies coming to us for, is just that control of their business. Sometimes a big equity check, you can lose a slight bit of control of your business. Obviously not early stage, but in later stages you definitely can. And dilution, is a big thing at the moment. So, I suppose holding on to that ownership of your company, a bit more control to get your business to that size where you can actually grow, and that's people use us for that.
So Matt, if I was looking to attract debt funding or to apply for it, what would hold me in great stead or put me in a position of being able to acquire it?
Yeah, I think now the environment with unit economics being so important has really probably will help us. It has helped us. It's helping us at the moment where our deal flow is coming through, and that quality of deal flow is improving. Companies traditionally, when they get venture, they're on a pretty high burn path. They're trying to grow at all costs, get the top line revenue drives your valuation, so they just want to grow. Now unit economics and runway is very important. So the key things we look for are growth in a business. Now debt doesn't have to be huge growth as long as the business is growing, whereas venture might be looking for, want to get exponential growth. Runway is a key thing. So the earlier you come and visit people like ourselves and inquire, the more likely we can do something for you. We want to see a good indication from our point of view would be, a snapshot view would be, we want to see 12 months of runway or so with our money plus the money you have in the bank on current sort of net cash burn. So if you can have 12 months of runway, that's probably in good stead. Lower churn, no massive customer concentration, and you'll be in a good position to get an offer from us.
Jackie, can I just one? I think when we looked at venture debt at the very start, we saw there was a little bit of a gap there and in the US, it kind of venture debt makes up around 10 to 15% of venture capital fundraise. In Australia, it's, and correct me, Matt, if I'm wrong here, that's probably more like 3 to 5%.
Correct, yeah.
So, we see that, it has a purpose in other markets, and it could really, help in this market for startups as well.
And
so that's the reason we're in there.
We often work side by side with equity, so we'll often come in side by side. Equity check will come in, and they top it up with some debt, which satisfies that runway requirement I was talking about. So they work hand in hand, and there's definite places where you don't want to take debt, and definite places where you want to take equity over debt. So Kathy probably goes.
It is hand in hand, but I would just say 5 years ago, interest rates were at a very different level than they are now in the US. So you saw quite a push to debt because it was very feasible and reasonable back then.
Yeah, and I was actually just going to pass on to you, Kathy, and moving on from the debt side, but then looking at the VC space and what is seed space as a VC actually looking for when investing in fintechs?
So we are a really early stage venture capital firm. We're ESVCLP here in Australia, which means we have a very specific regulatory structure that has some tax incentives for anybody who wants to come and invest in the fund. We can't get enough money in the fund to invest in startups. We've got a massive pipeline, and there is not enough cash to go around right now for very early stage. And when I say early stage, I mean we are the first corporate, if you like, investor after friends and family rounds. At the moment, so going back to our themes, there's not enough avenues to access capital and liquidity for early stage startups. We look for really passionate, driven founders who are subject matter experts that surround themselves with good people. They need to have a really great idea, and it's actually an idea that needs solving too, because there's a lot of great ideas out there, but not all of them want to get solved. There's inertia in the ecosystem they're looking in. Some interesting and innovative tech or use of technology to solve that problem, but it doesn't have to be built yet. We can often invest at ideation stage, and certainly everything is at pre-revenue. So we're really grateful that these two pieces of the ecosystem are here, right? So we don't tend to have crowd-funded companies because we're very much in the fintech capital market silo, but I've definitely invested on the virtual platform in a whole range of things, and in fact one of our investee companies in the fund is called Liquidize, which is previously Boulevard Global, which is a digital share registry, and several of Birch's companies are actually now listed on that as a digital share registry, which is bringing transparency, and we hope ultimately to be able to create a platform on that piece of tech to enable unlisted equity to be transacted amongst people. So you've got a market there to create value and liquidity for those unlisted investments. So we're really after passionate people. You have to really like people to be at that stage of the business. And we also want founders to come to us with an ask other than capital, because we've got a pretty diverse team with really deep experience across financial services globally, and we hope that they would want us to help from an advisory ad hoc level, even right through to being on boards. We don't mandate that at all, and we'd hope that they would also want to tap into our networks. So it's we could only encourage more money to come into this space. What we're seeing is development of alternative assets as far as an investment class across the board here in Australia. Financial advisors are now looking at unlisted. Obviously, there's a focus on that. You know, you've kind of had 12 months of profits and revenue. You may not be cash flow positive, but you're on the journey to that. So people are kind of looking at that end, but I would encourage the real upticks for those that are looking in this are very much at that early stage. And I'm hoping that through initiatives like Startup Vic, and I wish all the other states would do it, John. I really do wish all the other states had done as much as Victoria has now. We would have a less disaggregated investment structure here.
I was actually just going to throw it back to John and say, you know, Kathy, from that point of there not being enough capital injected into the early stage startup space, and particularly in the fintech sector, John, what would you suggest in terms of from the private sector encouraging more injection from a finance perspective, but also how can the government, whilst the government is doing a great job, how can we do even more, and how can we do it together collaboratively as an industry to really help create and promote fintech and further get FinTech Australia on the map?
I think for the government, we have to know the problem to be solved. We have to justify the interventions and so forth. And we don't want to be crowding out the market. There's no need to. We won't do that. So for people to come to us and talk about, and we were just talking very briefly before this started with Matt, you know, how can we help? Just we're the government. How can we help?
Where do we start?
Where do we start?
I've got one idea.
I think the crowd would
I'm
have
not
many
federal.
as well.
I'm not federal government.
Okay.
You can't classify us all together. But I think that we're open for discussion. You know, we'll talk to people about, you know, as we did earlier the piece with venture debt. We spoke to them about, you know, what's missing, and then we kind of came in to support. I think the other thing for government, we need to go in with private sector as well too, as much as possible. You know, we need to see, you know, skin in the game, and we need to see them having some conviction about it as well too. So if we know the problem, we see the private sector is there to kind of match fund with us and support us, then they're the type of things we'll look at. And there is a track record where we have done it, but yeah.
I'm really conscious Matt hasn't spoken, but I just want to say two things, John, and I know you're not federal. But from a state thing, educate family offices and financial advisors, because they have risk capital to deploy and they don't know enough about unlisted, and that's something you can do at a state level. At a federal level, we are the only G20 nation that doesn't have our sovereign wealth fund allocate directly to our own startup ecosystem. The Future Fund in Australia allocates to 14 VCs. All of them are international. None of them invest in Australian early stage startups. They all invest offshore. Now, those investments are going really, really well. Tick, right? That's great. But we have enormous wealth of experience here, and some of that money should and could be deployed here. And I think if we just even opened up 0.5% of that fund to our ecosystem, we're often flying, and hopefully we can catch up to our peers.
Yeah, no, I totally agree. It's the federal government.
No, and great comment there, Kathy. 100% agree with that, and I think that's also a fabulous segue over to Matt, who actually comes from a very different perspective of raising capital, and I'm really curious. I've got some structured questions, but I want to throw you under the bus because you didn't attend our practice. No. I'll start with one that you'll know. So equity crowdfunding has gained popularity as an alternative funding method. How can fintech companies actually leverage this approach whilst ensuring transparency and building a community of investors as well?
It's exactly that community point. What we do, or the unique feature of crowdsourced funding, as it's called in Australia, is We can facilitate offers that retail investors can participate in, and that results in quite literally offers with hundreds or thousands of investors, and that's naturally a pretty terrifying thing for most founders to think about. A lot of the governance arrangements or a lot of the practical things can be dealt with the right governance arrangements in place, and that's certainly an exercise that every company goes through. But building communities, like what we've observed over the last 5 years, is that the companies that do this really well really lean into that principle, that they're essentially building a community around them. It's the capital is incredibly important, but it's all of the other things that you're getting as well. And there is no downside to simplifying your message to a retail audience. I think sometimes, particularly fintechs, they get wrapped up in the solution. They're comfortable with pitching to investors that are comfortable with dealing with complexity, but every wholesale or institutional investor is also a retail investor. So that's really what we focus on as a platform, is trying to distill your message to its simplest form. I think what I'd say about crowdfunding, and I love being part of this conversation, but I don't see us as a distinct source of capital. I think people will see that actually we're an incredibly efficient way to organise a round of capital made up of multiple types of investors. And founders have amazing choice now, whereas in the past, using financial products to fund the early stages of their businesses that aren't appropriate for them. But now there are so many pathways that companies can use to raise capital and build their communities.
Can I just say, just want to add, because I spent 18 years in the UK and I've been on Cedars since they started back then. I was so encouraged when I came back to see the Birchells of the world here, and there's a smaller pool of you now, and it's a massively important piece of the capital ecosystem, angel investors and crowdfunding, and we need to encourage and grow it.
So following Kathy's conversation around there not being enough funding, or finding not enough investment to actually back the number of startups that we've got coming through the industry, how do you find on the Birchall platform, are you getting enough investors on there, and or is there enough deal flow? I'm
delighted to say that we are. And, it's no secret that the last 12 months have been pretty tough across the board for fundraising. FY23, we were down about 25% in funding volume against 70% drop in broader VC and 80% ASX. But everything that we were putting on the platform was getting done. And anecdotally, there are investors that, this is the first time that they're exposed to this as an asset class. These are people that can invest, but they're not people that go to startup events or are part of an angel group, but they see a business and identify with their mission, and it's fairly frictionless for them to get involved. So on the capital piece, there's 9 million potential investors that we can target through crowdsourced funding, thanks to the government making it possible that we can advertise these offers. And I see that as an incredible opportunity for all businesses, because there are lots of Australians out there that do have capital to invest and want to get to know these businesses.
And wouldn't it be amazing if our government embedded some of the initiatives that our peers overseas, like in the UK, have done, like the Seed Enterprise Investment Scheme, that meant every person who earns a salary can invest up to, so in the UK you could invest up to £1 million per annum every year if you had that much, and get a 50% tax credit back immediately on that investment, plus through other ways of deducting you can get up to 87% back. What a huge flood of money would come into an unlisted market, right? We just need to see more programs like that.
Yeah, just quickly on that point, and I think it is, so there are great, the ESVCLP and, other incentives for wholesale investors, predominantly rich people, if I can put it that way. And that's great. That's awesome. And it's really helped the industry. But now that this asset class is available to retail investors, I think it's time for us to have a think about how we can level the playing field, because retail investors are shouldering the risk, getting involved at an early stage. There should be similar benefits for them at scale as well.
So I think we can agree, whilst there is some fundamental changes happening and we're navigating that change, there's still a long way to go, but but it's certainly all heading in the right direction, which is really exciting for the industry at large as well, and certainly watching the growth of the startup industry in Australia. We've got probably about 2 minutes left, if that. Do we have any questions from the audience? I'd love to open up one at the back there. Can we grab a mic? Yeah. Thank you. That way. Straight through, yep.
Thank you, everyone. It's a question mainly for Matt. So has there been much traction for B2B businesses who are mainly selling to other businesses in fintech on these crowdfunding platforms?
Lots. And I think, look, we've done lots of craft breweries and distilleries on the platform, and, you know, they're lots of fun, but that's not the end of the story. I suppose we take the view that someone that buys your product might also like to invest in your business. So it certainly gives us a real head start if they're a B2C in terms of how we're going to market the opportunity and what the natural audience might be. But Thriday is a great example. We raised $3 million for them in 2021. Seabin Project is another example. It's a bin that sits in the water, collects waste plastic. You or I would never buy a Seabin. It's like buying a street light. But people care about what they're trying to do, which is clean up the world's waterways. So to put it simply, it's about the story, it's about the audience, and it's about building community. And I think framing it in that way means that the B2B, B2C thing is kind of irrelevant. It's what community you're trying to build.
Thank you.
Any other questions?
Can I also just add to Matt's comment while you're looking? We're getting increasingly educated as an investment community too in Australia. I think we've got a highly literate population. Sorry, is that our 5 minutes? And you know, your point before about wholesale investor versus retail, if you go anywhere else, it's just an investor. And we've got all these things you've got to satisfy, and it's crazy, right? We've got really strong education, really strong financial education. People understand equity, they understand debt. So I really think it's time to have some wholesale change here in Australia and free up our system a little bit.
Yeah, absolutely. I think we could all agree to that. Thank you, everyone, for listening, and thank you for my amazing panel for answering the questions.
Thanks, Jackie.